According to Pepperdine University, more than 1/4 of business deals that fall apart do so because of what's called a valuation gap. The owner expected one price, the buyer came in with a completely different perspective, and the deal dies. What makes that quarter of a business deal falling apart because of the valuation gap so interesting is that most of these business owners had a valuation done. They knew what their business was worth, or at least they thought they did. They had a report, they had a number, and they still walked into that negotiation completely unprepared for what the buyer actually found when they looked at their business. So the question that I want to spend some time on with you today is this. If a valuation tells you what your business is worth, why are so many business owners getting blindsided and not selling their businesses? The answer that we've been taught to overestimate what a business valuation does. And if you're a business owner who's doing anywhere between $1 to $25 million in revenue, and you have these big aspirations of an 8 or a 9-figure exit or generational wealth or financial independence, I want to show you today exactly what you're getting when you get a business valuation, what you're not getting, and then simultaneously, what are the businesses that actually get the outcomes that you've sought doing differently? This is not meant to be a knock on valuations. There's a time and a place for valuations. I want to show you exactly when that time and place is, but in my opinion, there is a better tool for what you're trying to accomplish. And by the end of this video, you're going to understand exactly why I believe that. Let's start at the beginning, because I think a lot of business owners have a fuzzy picture of what a valuation actually is and what it's designed to do. Business value is an estimate of the economic value of your business at a specific point in time. It is backward looking by design. It takes your historical financial data, typically 3 to 5 years worth of it, and it applies a methodology, compares you to other businesses in your industry that have sold, and then produces a number. And that number represents what your business would theoretically sell for today under current market conditions to a hypothetical buyer. That's it. That is the job of a business valuation. And when it is done well, it does that job very accurately. There are 3 main approaches the valuation professional uses. Number 1 is the income approach, where they look at your earnings and they apply a multiple or a discount rate. The second is the market approach, where they compare your business to similar businesses that have recently sold. And then thirdly, there's the asset approach, where they're looking at what you own minus what you owe. Most valuations for operating businesses in the 1 to 25 million revenue range use a combination of the income and market approach. There are professional standards that govern how this gets done. There's the NACVA, and then lastly, there's the USPAP. All of those set requirements for what a credentialed valuation must include. And a properly done will address things outside the number, things like customer concentration risk, key person risk, and very basic industry trends. But here's what those standards do not require. They do not require the valuation to tell you why your multiple is what it is, in plain language that you can now act on. They do not require it to show you what a specific buyer would actually see when they run their own analysis on your business. They do not require a path forward or a map on what to do next. They do not tell you how to fix things, what to build, or what things to eliminate before you go to market. They just give you a position. They do not give you a plan. And here's the part that I find a lot of people completely miss. Studies show that intangible capital, things like brand, your systems, your team, your proprietary processes, your customer relationships, can account for up to 70% of a business's total value. 70%. A standard valuation is not built to measure that with any real precision. It acknowledges those factors exist. It does not quantify what they're actually worth or tell you how to build them or fix them. So if the majority of your value lives in the intangibles, and your valuation is primarily built off of financial history, you are working with an incomplete picture of what your business is actually worth. That alone is a reason to want more than a number on a page. For a lot of business owners, when they do evaluation, it gives them this feeling that they're informed. The problem is that feeling informed and being prepared are 2 completely different things. Let me show you how this market actually works, because most business owners have no idea, and there are a lot of different options, and with this much variation in what you actually receive. In tier 1, or the bottom of the market, You have automated and broker level valuation tools. We are talking anywhere from free to about 1,500. These are tools like Nimbo, BizEquity, BizX, or your local business broker. You plug in some financial data, you get a report back. It's usually about 10 to 25 pages. It gives you a ballpark range based on revenue multiples and a lot of industry data. It is fast, it is cheap, and it is useful for a very rough orientation of where you are. If you've never thought about what your business might be worth, this gets you a number and can be a good starting point, but it really is, that's all it does. The next tier, or tier 2, or one step up from that, you have what I would call the Certified Small and Medium-Sized Business Valuation, or the SMB valuation. This is the range that most small business owners are operating in when they go get a valuation done. You are spending roughly $2,000 to potentially $8,000. You get credentialed reports from someone with a CVA designation or an A designation. It's going to be about 40 to probably 80 pages in length. It'll include the income and market approaches. It will normalize your EBITDA. It does industry comps and does give you a risk assessment as well. You'll find firms like Peak Business Valuation, Eton Venture Services, and things like BizWorth operate in this range. This is the product, this is the range that most lenders, things like the SBA and many attorneys, will accept for their purposes. In the third tier, or the range above this tier, you have what we call transaction grade professional valuations. These typically run from about $8,000 to $5,000. This is where you go when you're starting to get into deeper financial forecasting, when you want more detailed comparison sets between this business A and business B, when you want a more defensive narrative, that you're going to go to this price point. You're going to look at firms like Mercer Capital or Stout or RSM. They do this level of work, and there's a lot more than that as well. This level is appropriate for you when you are preparing for a transaction of $5 million or more, or where there's a buyer who wants to conduct a serious amount of due diligence on you. This gives you a more defensible position. You can also use this in a partner buyout. If you're going to go do an ESOP, this is the level that you have to start at. Or if you have some sort of litigation where they want a really dialed in valuation number, this is the level that you have to play at. There is one more tier above this. It's not available or even sought after for most small to medium-sized businesses, but I want to make you aware of it. This is the top of the market. This is what I would call institutional grade advisory work. This is what the Big Four, this is what investment banks do, McKinsey, and private equity-backed advisory firms deliver. We're talking in the ballpark of $50,000 on the very low end to a full set of advisory processes running well into six figures and beyond as the top end of the market. At this level, you're not just getting a valuation number, you're getting a quality of earnings analysis, a transaction narrative that's been built for that specific buyer. You're getting capital market positioning, you're having legal and structural diligence reviewed, and you're getting a full picture of what the business is worth and why it's worth that, and what a buyer will potentially push back on, and then how to maximize the outcome that you're seeking. That's quite the range. 3 to 200,000 plus. And what you get on either end of that range is not even close to the same product, but they're both labeled valuation. But here's the thing. Most business owners who are doing 1 to 25 million in revenue are buying something that's usually for a valuation about $2,000 to about $8,000 in price. They are getting the certified small and medium business valuation. And they're walking away feeling like that number on that report is what they're going to get no matter what. And I want to be honest with you here, because I'm not trying to tell you that valuations are useless. They're not. There are specific situations where evaluation is exactly what you need, and trying to substitute something else would likely be a mistake. If you're going to the bank for an SBA loan or a commercial line of credit, you need a certified valuation. The bank is going to require it. It's a specific format, it's a specific credential, a specific deliverable. You go to tier 2, and that's what you pay for, because you need it to get the SBA debt and the capital that's going to help you grow and reach your aspirations. If you're doing some sort of estate planning, if you're doing gifting of shares to family members or dealing with a trust, evaluation is a legal and tax requirement. So again, the IRS has a very specific standard of what they require. So you're going to go to that tier 2, and that will be an acceptable, it will meet the professional standard that's met for that. If you are exploring an ESOP as a transition strategy or an exit strategy within your business, Evaluation at the tier 3 is required. Like, you should go do that. If that ESOP is going to give you the exit that you need to live the life that you want to live, you're going to need that level of valuation. And then the last one is, if you're early on in your business ownership journey and you've never had an independent sense of what your business might be worth, go get one of the tier 1 valuations so that you can understand, okay, I got a good sense, a rough idea of what my business is worth. It doesn't have any stakes, but it gives you a rough idea. For all of those situations of getting valuations, I encourage you to pay for the right level of credential, because that's the right tool for what you need it to. But here's where I would really like you to pay attention. If what you're trying to do is understand what your business is actually capable of, where the gaps are, what a buyer is going to see when they're looking hard inside of your business doing due diligence, or what you need to do between now and your exit to actually get the outcome you want with any level of predictability, it's most likely that a standard valuation is not built to answer those questions. It was never really designed to, in all reality. And treating it like it does is where a lot of business owners get into trouble. And by trouble, I'm not selling their business at all, or having to settle for substantially less than they expected, or being forced into a lengthy earnout that keeps them handcuffed to the business for years after they thought that they were done. When a private equity group or a sophisticated strategic acquirer looks at a business, they're not relying on your valuation. They're running their own process, and that process looks nothing like what you paid in that $2,000 to $8,000 tier to receive. Their team is running a quality of earnings analysis, which means that they're rebuilding your EBITDA from scratch. They're validating every adjustment you made. They're testing whether your earnings are real, repeatable, and transferable. They're looking at your customer concentration. If 20% of your revenue comes from one client, they're pricing that risk into the offer that they give you. And it doesn't matter if you flag it or not, they're going to find it. Assessing key person dependency. If a business can't run without you, they're going to discount their offer that they give you. They'll build protections in the deal to account for what you don't provide. They're modeling your market and looking at where your industry is heading and what the tailwinds and the headwinds are telling them, and what a buyer could absolutely get when it comes to an ROI perspective. Is there actual upside for them when they purchase your deal? And here's the piece that too many people just completely neglect. They are evaluating your intangible capitals. It's your brand equity, your systems, your team, your proprietary processes, your culture, the customer relationships. Remember that stat they said earlier? Up to 70% of business owners' value can live inside of the intangible capitals. A sophisticated buyer knows exactly how to measure that. They have seen dozens and potentially hundreds of deals in your industry alone, and they know what a strong intangible capital business looks like. And they also, on the other end of the spectrum, they know what a fragile intangible capital business also looks like. And they're going to price their offer accordingly. And none of that is going to be in the valuation number that you have in your report. That is what I like to call information asymmetry. That is what is actually driving the gap between what owners want and what they actually receive. And it's not that the valuation lied to them, it's that the valuation only answered one question when there were 10 other questions being asked on the other side from the buyer's perspective that no one prepared them for. Let me give you some specific situations where I believe that this matters most, and this actually starts to become a big deal. Situation number one, if you are a business owner with an 8 or a 9-figure target, but you don't know where you stand today. This is honestly probably the most common one that I see. Someone has a number in their head. They want to sell for 10 million, 50 million, 500 million. They've always either said it out loud or they've just kept it quiet in the back of their minds, but it's always been a part of their aspiration. But they've never really mapped out the distance of where they are today and where they want to go. Evaluation would tell them you're worth 3 million today or you're worth 15 million today, but it does not tell them where what their business is actually capable of getting to. Can their business actually get to that number that's in their head that they've always said that their aspirations are telling them to push for? It doesn't tell them what they have to change. What behaviors do you need to switch if you're going to get to that number? It doesn't tell them how long it realistically is going to take to get to that number. If that's you, do not need a business valuation. You need a diagnostic that shows you what the unit economics of where you are today and what the unit economics need to be to get to where you want to go. And then from those 2 points of access, you can create a plan that makes it possible, and you can start to learn, am I actually capable of getting there, or do I have to change something? Do I have to do mergers and acquisitions? Do I have to do a partnership? Do I have to do something differently? Evaluation doesn't tell you any of that. The second instance where I think things need to be different is for the owner who is about 3 to 5 years away from an exit. This person has time to act, but it's not an unlimited time. They need to know what it is a buyer is going to see before the buyer even shows up. They need to know whether their earnings are transferable, whether their customer base is concentrated, whether the business can operate without them in the room, and what moves they need to make right now over the next few years that will increase their multiple, not decrease their multiple. Evaluation is just going to give them a snapshot of what the market would pay today. 3 to 5 years is plenty of time to move that number in a meaningfully way to actually get to your wealth aspirations, but it's not enough time for you just to dilly-daddle and trial and error along and do, if in some instances, just stick with organic growth. Like you might and most probably have to do something differently, but it isn't going to tell you how to fix that. The third instance is the owner who is exiting right now and needs to tell a story. So if you are actively selling your business right now, the numbers matter, but the narrative actually matters more. When a sophisticated institutional buyer comes to buy your business, they're buying your thesis about your business and what it can become. If you walk into that process without your own version of that story, with a clear, articulated way of this is what the tailwinds of our market, this is the growth vectors that are available, here's the strategic upside for you as a buyer that you can capture on, it's likely that you're going to leave money on the table, because a good diagnosis is going to give you a story with the data, and that's not just you having optimism of it. You can convince them with defensibility that you should pay this price because of what it can become. So if you're selling your business right now, you need a narrative story to get it there. The fourth is the owner who suspects that they're leaving money on the table. So you don't have to be heading towards an exit to get this level of clarity in your business. If you've been running your business for 5, 10, or 15 years, and you've never had someone look at the unit economics and the profit gaps in your operational structure and your marketing position through this investor objective lens, there's a very good chance that you're underpaying yourself in ways that you cannot see from the inside. The diagnostic, the institutional level view that usually costs $50,000 to $200,000 is what you actually need to capture the money that you're leaving on the table right now, not just when you go to exit. And then the fifth thing is the owner who wants to think like an institution. Those large businesses, the 8, the 9, the 10-figure revenue companies, they go to McKinsey, they go to the Big Four, and they spend $50,000 a year. They'll spend $300,000 a year to get that level of analysis. Not because that they're being forced to by a bank or the IRS or a legal team, but they're doing it because they view themselves as an institutional investor grade business. And that's how they make decisions. They want to know, what does the actual data say about where we are? What is suppressing our value? What moves can we actually make that change that outcome? If you're running a $5 or $10 million business and you want aspirations for a $50 million business, or if you're running a $1 million business and you have aspirations for a $100 million business, you need to start to consume the level of information that those businesses have at those levels. It's going to change the way how you run your business and not just how you sell for it. So if you want to become the 8-figure success story, you have to start behaving like they behave right now. And that's the level of data that they get. They don't just get a valuation, they get the full scope of what the valuation means, which is what I've been trying to make this point this whole time, is if we want to become an institution, we have to behave like an institution. What should you actually be looking for if a standard valuation is not enough? Here's what I would tell any business owner in the 1 to 25 million revenue range. You want an analysis that does a minimum of 4 things beyond giving you a valuation number. The first thing is it should show you why your multiple is what it is. Not just a number, but the specific factors in how your business is either supporting or suppressing that multiple. Customer concentration, key person risk, earning quality, revenue, operational systems, your intangible capitals. You need to know which lever actually moves the price up or down. 2, it should give you a buyer's lens. What does a sophisticated acquirer actually see when they look at your business? Are there glaring red flags? What are the value drivers that they're looking at? You want to know what they know before they sit in front of you. 3, it should connect your business to the market. What are the tailwinds and headwinds in your industry? Where is the market heading? What does this mean for the attractiveness of your business for a buyer right now versus in 3 years? 4, it should give you a path, not just a where you are, but what changes move the outcome. What specific prioritizes things can you do to make your numbers different so that you're more attractive and defensible to a buyer? If you're looking for something that does all of that, I would point you to our Wealth Blueprint Diagnostic. It was built by us for business owners just like you in the $1 to $25 million range so that they can get an institutional grade picture like the McKinsey, like the Big Four, into what your business is at this exact moment, but more importantly, of where you're going to go. It includes it, but it goes well beyond that across all 4 of those dimensions, including a deep dive into your individual intangible capitals. You can find a scheduling link to discuss whether that's a good fit. You can find that in the description or in the comments below. But if you're someone that has aspirations for an 8 or 9 exit and you want to become institutional, that's the view of what you have to take if you want to behave and if you want to create predictability around your outcome that aligns your wealth aspirations with what you're actually seeking deep within your soul. Evaluation is not a bad tool. It's just a limited one. And the owners who get to the exit that they actually want, the ones who hit the numbers and walked away with something generational, did not get there by just knowing what their business was worth. They got there by understanding their business the way a buyer understands it, the way an investor understands it, long before they ever actually sold it to someone else. That is the standard of worth holding yourself to. Not what is my business worth today, but what does it take to get this business to where I want it to go? Am I building toward that, or am I doing what everyone else does and hoping that I just arrive at my desired exit? If this was useful to you, share it with a business owner who needs to hear it. And if you want to go deeper, check out our Wealth Blueprint Diagnostic in the description or in the comments below. It is a starting point for every serious conversation we have with the founders who want to close the gap between where they are today and where their aspirations are driving them to. I'm Justin D. Maxwell. Thank you for watching.